Welcome to Talk Tickers. U-Haul's latest earnings report, it's a real head-scratcher. It's like a tale of two very different stories playing out at the same time. On one side, you've got incredible strength, but on the other, there's some serious pressure building up. So let's just dive right into the core conflict this quarter. You've got record revenue, hitting $1.72 billion, a really solid jump year over year. But on the flip side, profits just completely collapsed. I mean, it's a massive disconnect that really caught Wall Street off guard. And just to put a hard number on that profit miss, U-Haul delivered only 49 cents per share in earnings. Now, the analysts, the folks who get paid to predict this stuff, they were looking for 87 cents. That is a staggering 44% miss. Just wow. So the big question is, right, how does that even happen? How can you sell more than ever before but have your earnings get sliced almost in half? Let's get into it and unpack this profit squeeze. Well, it turns out the culprit is pretty much a single line item, and it is a monster. A $107 million surge in costs compared to last year. This all comes from two things: fleet depreciation, the value their trucks lose just from aging, and actual losses when they sell their old trucks. This one factor basically erased all the gains from their record sales, and then some. And you know what's interesting? Management isn't trying to hide from this at all. The chairman, Joe Schoen, was incredibly blunt on the earnings call. He straight up acknowledged the earnings crush and then warned investors that this pounding, his word, not mine, is likely going to continue for a while. You gotta appreciate the honesty, right? Okay, so that transparency is great, but it immediately raises the million-dollar question for any investor looking at this stock. When is this gonna stop? What's the timeline here? When does this painful cost cycle finally turn around? And here, they've actually given us a roadmap. Management is telling us they expect these costs, specifically on their box trucks, to peak towards the end of this fiscal year. After that, things should kind of flatten out for a bit, and then, and this is the key part, finally start to trend lower. That is the inflection point, the light at the end of the tunnel that everyone is going to be watching for. So you see profits getting hammered like this, and you have to wonder, why? Why are they letting this happen? What is the long-term goal here that justifies taking all this pain right now? Well, their strategy really boils down to three core pillars. First, they are pushing hard to expand their dealer network, getting more of those orange trucks into more neighborhoods. Second, and this is a big one, they're building out their self-storage footprint like crazy. And third, they're really trying to grow their U-Box business to take on competitors in the container space. Now, renting trucks is still their bread and butter, no question. But the real growth engine, that's self-storage. You can see it right here. That piece of the pie was up almost 10% year over year. And that is so important because it's steady, high-margin, recurring revenue, exactly what long-term investors love to see. And we're not talking about a small expansion here. I mean, the scale of this is just immense. They've added about 1,000 dealers in the last year alone. And on the storage side, they just added another 1.6 million square feet of space this quarter, with over 14 million more in the pipeline. They are spending a ton of money to build a competitive fortress. Okay, so you hear 44% earnings miss, and you'd expect the stock to just fall off a cliff, right? But the market's reaction was, well, surprisingly quiet. And that tells us there's a whole other side to this story. The stock barely budged. It fell less than 1% the day the news came out, and trading volume was pretty much just average. There was no panic, no big rush for the exits. This tells you the market is weighing two completely opposite narratives here. And this right here is the heart of the matter. It's a real tug of war. The bears, the skeptics, they see the crushed earnings, the heavy spending, the high debt, and a stock that's been a real dog for the last year. But the bulls, they see something totally different. They see record sales, this incredible storage business they're building, a dominant market position, and they're thinking, hey, maybe this stock is deeply undervalued right now. All right, so let's put all this together and look ahead. What's our prediction for the next quarter, and what's our final rating on the stock? For next quarter, honestly, we expect more of the same. Revenue will probably grow a little bit, mostly thanks to that strong self-storage business. But, and it's a big but, we think earnings per share will likely come in below what Wall Street expects again, because those depreciation costs are still going to be a major headwind. So for the stock price, we see it stuck in a holding pattern, probably trading sideways while everyone waits for that cost inflection point. So given that balance, the serious near-term pain versus the clear long-term strategy, we are officially initiating our coverage with a market perform rating. The potential for upside is definitely there, but the timing is just too uncertain right now.
So to sum it all up, U-Haul is a transition story. Management is making a calculated bet, sacrificing profits today for what they believe will be total market dominance tomorrow. The one key thing, the catalyst you have to watch, is the quarter when those fleet depreciation costs finally peak and start to come down. That's the green light the market is waiting for. And as always, please remember, this is not financial advice.